U.S. natural gas started the week with another attempt to move higher, but once again the market discovered that hot weather and bullish enthusiasm are not quite the same thing. September NYMEX natural gas settled Monday at $2.75, up just 0.3%, after trading higher earlier in the session. The main support came from persistent heat across Texas and the Southwest, but updated weather forecasts turned slightly cooler during the day and erased much of the early advance. Above normal temperatures are still expected across Texas and the Southwest into early September. The bullish weather story is certainly still alive. West Texas is facing exceptionally hot conditions, while ERCOT expects peak electricity demand this week to challenge or potentially exceed the record established in July. More air conditioning means stronger power burn, and therefore more natural gas consumption. The problem is that the heat is concentrated heavily across the southern and southwestern regions. That is useful for demand, but not nearly as powerful as widespread heat extending through the Midwest and, especially, the densely populated Northeast. In other words, Texas is doing plenty of heavy lifting, but the bulls would probably appreciate a little help from the rest of the country. And then there is production. Lower 48 dry gas production was around 112 billion cubic feet per day Monday, about 2.3% above last year's level, while lower 48 demand was approximately 77.7 billion cubic feet per day. Last Friday, production had reached roughly 113.1 billion cubic feet per day. That remains the biggest obstacle to a sustained rally. Producers apparently did not receive the memo that prices below $3 were supposed to encourage them to produce less gas. The latest Baker Hughes report did little to change that picture. The gas rig count declined by only one rig to 127, still relatively high and nowhere near the kind of decline that would suggest a meaningful production slowdown. Meanwhile, another supply issue is approaching. Energy Transfer's Hugh Brinson pipeline is expected to reach its full 1.5 billion cubic feet per day transportation capacity around September 1, bringing additional Permian gas toward Henry Hub just as summer cooling demand begins its seasonal decline. So the calendar is not exactly doing the bulls any favors. There is at least one genuinely constructive development. Last week's EIA report showed an injection of only 16 billion cubic feet, compared with the 5-year average build of 29 billion cubic feet. That means sustained summer heat is finally slowing the pace at which the storage surplus grows. But inventories were still 6.2% above the 5-year seasonal average as of August 14. The EIA currently projects inventories near 3,985 billion cubic feet by the end of October, around 5% above the 5-year average and potentially the highest end of injection season level in a decade. Therefore, several more bullish storage reports will probably be necessary before traders begin treating tightening inventories as a structural bullish argument rather than simply a temporary consequence of summer heat. LNG demand remains another important piece of the puzzle. Recent LNG flows were around 17.7 billion cubic feet per day, below the previous week's level, partly because export facilities have been undergoing maintenance. The EIA says maintenance at Freeport LNG, which affects roughly 2 billion cubic feet per day of nominal export capacity, is expected to finish in late August. That makes the next couple of weeks particularly interesting. If Freeport returns toward normal operations while temperatures remain hot, additional LNG feed gas demand could combine with strong power burn and produce another sequence of relatively small storage injections. That would finally give the bulls something more substantial than another weather model run to celebrate. Technically, natural gas is slowly turning bullish, but the breakout still needs confirmation. The $2.70 to $2.75 zone is the first important support. Holding above it keeps the recent higher-low structure intact. Below that, $2.65 is the next support, followed by the major $2.60 floor. On the upside, $2.80 to $2.85 remains immediate resistance. A sustained break above this zone could send prices toward the 50-day moving average near $2.91, followed by the psychological $3 level. For now, $2.70 to $2.80 consolidation remains the most likely scenario, with a break above $2.90 providing stronger confirmation that the August bottom is developing into a broader bullish reversal. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.